Hey everybody, welcome to another Lund Loop AMA. This is where subscribers, you, can ask me anything about markets, trading, or life. Everyone that's watching this right now is a paid subscriber, so let me just tell you how you can submit a question. Send an email with the subject line AMA question to brian@thelundloop.com. Please put that subject line in there. I've got a filter that will flag that for me, otherwise I may miss it. Keep the question brief and specific. 2 to 4 sentences is best. This is important. Sometimes I get these long questions, and sometimes I get questions like, what do you think of XYZ? It's like, I want to be able to give you the best answer possible, but for the best answer, I need a really specific question, and I need something that doesn't, it's not a novel. All right, what else? Avoid time-specific questions because I don't do this on a regular cadence. So if you ask me something about a stock today, by the time we do the AMA, it might be outdated. If you don't get a reply in a week, send the email again. Normally what I'll do is if you send it, I'll just quickly write back, hey, I got this, I'll add it. If you don't see me send that to you in a week, hit me up again. And finally, tell me if you want to be fully anonymous. I will never put anyone's full name here, but sometimes I'll do Mike S or Bill Q. So if you don't even want that, let me know. All right, let's jump into the first question here. First question is, do you have any rules or parameters when shorting put options besides being okay getting assigned? Do you avoid shorting puts ahead of earnings or a binary event before expiration? And do you prefer the higher premiums that may go with these upcoming events? Okay. By the way, these AMAs are not scripted. They're not produced. So I try to just give you the most raw, honest answers I can off the top of my head. So I've only recently in my career started using the strategy of selling puts to get into a position. I would say maybe in the last year or two. So it's not really been a bread and butter technique for me. Having said that, yes, the number one parameter is I have to be willing to take assignment of those shares. In fact, many times that's what I want to have happen. I've recently, in the last 6 months, built positions in different names by selling puts. In some cases, like with Poet, it worked out amazing. Other cases like Path, it was okay. In other cases like Bros, it didn't work out that great. But in all those cases, I either made way more money than I would have, or I lost less money than I would have, because selling puts to get into those positions brings the cost basis down. All right. In terms of other parameters, generally, I like to sell puts at the money or just a little bit in the money because I like the fatter premium there. If that also corresponds with selling a put at a strategic level, like a support or resistance level or a major moving average, I'll also do that. Sometimes if a stock is aggressively selling off, I won't sell it right at the money. I'll sell it maybe 10% out and hopefully truing that up with a technical level. But and then going to the question about the binary event or the earnings and the fat premiums. Yes, but this is super important. I never sell puts on the size of the full position I want. So let's just say I wanted to buy 10,000 shares of a stock. And remember, this is always going to be in the context of an active investment. I am not selling puts to get into a day trade or even really a swing trade. These are things I'm trying to build an active investment, which, just for reference, that's a stock you want to hold for longer term, but you want to use short-term trading techniques to bring the cost down or to trade around it. If I want to buy 10,000 shares of a stock eventually, I'll never sell 10,000, the equivalent of 10,000 puts. I will do like maybe 2,000 and then see how the stock acts, and then another 2,000 and then another. So I'll do it over time. And because I'm going to do it over time, yeah, I'll take a slice of that. And if it makes sense, I will sell a put in front of a binary event that gives me a fatter premium, because I know that if it goes against me, it's okay. I probably have 3 or 4 more bullets that I'm going to be firing over the course of acquiring that position. So, all right, next question is, what are your thoughts, not necessarily on blowing up, but more so death by 1,000 paper cuts? I dealt with that during the recent choppy October to March period. Kept my risk in check, but so many small losses added up. Appreciate any thoughts on periods where honestly it seems best to just sit out entirely. All right, so there's kind of 2 questions in there. Yes, this is something that I have dealt with over my career many times. So when you're trading, there's 2 types of scenarios for trading. One is strategic trading, and then one is more of like portfolio trading. What I mean by that is when the market is not necessarily in a real trending mode, when you're not getting a lot of swing trades, that's when you're more of a strategic trader. You have smaller amounts of trades on, shorter time periods. Those are like cash flow trades. But as markets are, as they get healthier, right, as a trend extends, you're holding more positions longer. So you almost have a portfolio approach. You have a wide amount of stocks, or a wide number of stocks that are still technically trading stocks. They're not investments. I have found in those times, at the end of the trend, right, or when you get some, out of the blue move, it doesn't matter how well diversified you are, and it doesn't matter if you have a lot of smaller positions opposed to 2 or 3 heavily concentrated positions. 25 positions all getting hit a little bit acts the exact same for your P&L as having 3 highly concentrated positions getting hit a little bit. So yes, having multiple positions when the market corrects can definitely kill you by 1,000 cuts. So the question is, how do we try to avoid that? And that's the tough part. So let's go to the chart here. So this is that period that, who was it? What was, did I have a name on that one? The MJ. This is the part that MJ was talking about from October of 2025 to March of 2026. Okay. So what did we have going into that time frame? Just that relentless trending market that I was talking about, right? So you're probably in a portfolio approach here. You've got lots of names because everything's working. You should be doing that. But then you get a move like this, the initial move. And I remember that day, the 10th of October, what a big smash down that was. And that was kind of a wake-up call, right? And if you had a lot of positions on here, yeah, that's going to hurt. There's really no way to avoid something like this. But then the question is, what do? Do you just keep your portfolio approach and not trim it down? Do you add whatever? Well, here's what happens. We go back up and we get back above here and it looks like, okay, cool. Maybe that was just an aberration. But then we come back in and we lose that previous high. That's a failure right there. And that's something to go, okay. Now look, we just went to the 50 and we had a reversal there, but that's something like, okay, here's a weird big bar that really came out of nowhere on this trend. Looked like we were going to break out, but then we kind of failed. All right, hey, we're back up here again, and then we fail again. And what do we have? We have a lower high in place. So we've had this shock here. We've had the breakout and fail, re-breakout, lower high, and fail again. So at that point, you got to be saying, okay, this may take some time to resolve, and I need to go from portfolio approach to strategic approach, or from portfolio approach to nothing, to cash, right? There's nothing wrong with being in cash. So look, that's just the toughest part of markets when you transition, and there's almost no way to get around it, right? Something's just in a relentless uptrend or downtrend, and eventually you get that one big day where you go, and then you see, like we talk about, does it build upon that move, or does it fail? And then you just adjust accordingly. So, all right, let's see. The next question is, I went strong, broke my sizing rule on 3 stocks and each doubled. Greed is my mindset with these stocks, not fear. I'm letting greed continue to overcome fear at this point. Greed says they'll double again. What would your mindset be in this situation? What's your take on the greed I am experiencing? All right. Well, I asked a friend about this, and here's what he had to say.
Greed, for lack of a better word, is good.
Now, come on. I couldn't avoid putting in a Gordon Gekko greed is good clip there, could I? Okay. This is an interesting question. And I just realized that this question here actually dovetails. It doesn't feel like it dovetails, but it does dovetail with the last question. And the question is, if you were younger and had a wife and a 9-month-old son, and your family left you over $100,000, what actions would you take to grow and protect it to create generational wealth for your family? All right, so we're going to go on a little bit of a diversion here, but I'm going to bring it back around to both of these questions. Let's start with the first question about generational wealth. Let me just make sure I got this correct here, the phrasing. To grow and protect it to create generational wealth. Okay, grow, protect. Absolutely diametrically opposite concepts. Let's start with our terms here. Generational wealth. I'm defining generational wealth not by a few $1,000,000 here, but like it's got to be in the, what is that, the 8 digits? It's got to be like in the tens of millions, right? That's when you're talking about generational wealth. In order to get that sort of wealth, you have to take risk, and you have to take a lot of risk. The generational wealth term is a little bit of a canard here because I used it recently in terms of, hey, the generational wealth project in trading. But here's the thing. The amount of risk you have to take with trading is just, it's too much, right? So you really can't create generational wealth with just trading. The reason I've used it recently is because I feel like we're in this very narrow window, a generational window that we only had back in the 90s, where maybe trading could create that generational wealth. I've since decided that it's just too risky to do it through trading. So, generational wealth. You've got to take a lot of risk. That means you've got to be an entrepreneur. That means you've got to be an innovator. You've got to be out there somewhere just go, 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 right? That's how you're going to get generational wealth. There's nothing protective about that process. So, and also taking $100,000 and turning it into generational wealth, again, the risk you would have to take is antithetical to protecting. I will also tell you another thing about that. The person that is doing that, and it's fine if you are, right? If you say, I'm going to take $100,000 and I'm going to just take on a lot of risk and I think I can do it and I can build this company, I'm going to be a VC or whatever you're going to do. That's not usually very compatible with being present for your 9-year-old son, right? It's a trade-off, right? The billionaires are not really there very often when there's thunder and lightning outside and your kid jumps into bed with you and you read him stories at night. Like the billionaires are not really there on family trips and weekend fishing and things like that. So there's a big question, like, to get that generational wealth, it's a trade-off. And it's not just a trade-off of risk, it's a trade-off of time, right? So having said that, your son's 9 years old. You could take that $100,000 and put it into an index fund. Market generally returns 9 to 11% over time. 40 years from now, 41 years from now, when he's 50, that's $3.5 million. It's not bad, right? But let's tie this into the previous question, all right? The previous question, which was, I went strong, blah, blah, blah. Okay, greed, right? Because there's a greed element to this question, right? To get that generational wealth. Remember, we've talked about there's no safe way to get the generational wealth. There's no protective way to get there, right? So go back to this greed question. Made a bunch of money on this stock. Greed says that it will double again. What's your mindset on what you're experiencing? The title of this AMA is Should You Buy, Sell, or Hedge? Okay. whether you should buy, sell, or hedge has to do with where you are in your financial situation, how you've done in this market, and what you want to accomplish. Also, your risk profile. Trust me, I'm going to tie this all up. So I've got a buddy who took, I think, $400,000 and turned it into $1.7 million during COVID because he had a beat on what he thought was going to happen. He got ahead of the crowd. He shorted a bunch of stuff and he made a lot of money. When he had that $1.7 million, he said to me, I should buy a house. I said, yeah. He didn't own a house. He said, I have my eye on this house. It was like $900,000. It was somewhere in LA. Cute little house. So I should buy this house. I feel like I should buy this house, but I got this 1.7 and I think I could get it to 3. And if I could just get it to 3, I said, yeah, but might not be a bad idea to take some money out of the market. You made a ton of, long story short, he gave the whole $1.7 million back. Okay. So he's in the market again. I mean, he stayed in the game. And guess what? He's up $2 million this year. And what's he doing? He's saying, I should take some money out of the market. I should buy this house. And he's looking at another house, $1.2 million. Great house. Well, it's a beautiful house. Doesn't own a house. And I said, yeah. Like, remember last time when you were going to take the money out, you didn't, you felt like crap when it all went away. Like now, right? That's a hedge. Taking money out of the market is a hedge. So like if you've killed it, you can certainly hedge your positions. Like you can take a position that you're up $100,000 on and take 10 of that profit and just buy the equivalent amount of options and reduce your risk, still keep your upside, right? You can do that. That's a hedge. You don't have to sell something outright, but you can also hedge by taking money out of the market. Like if let's just say you took $250,000 and you turned it into $1 million. Take $500,000 out. You took 250 to $1 million, right? Now you got double what you started with. That should be more than enough capital, right? And this all reminds me of my godfather and how he created his wealth. And this goes back to the other question, the one about the 9-year-old child and how do I protect and grow, and the advantage there is twofold. One is you have time. And number 2 is you don't need the money, right? Like my buddy that went from 400,000 to 1.7, he didn't need that money. It was in his trading account. It wasn't affecting his everyday life. It's not now, right? It sounds like that $100,000 is not affecting your everyday life. But I go back to my godfather. And so the way that he got his money is that he dropped out of high school. He was a construction guy, but he really liked machines. He loved the process of construction, demolition and whatever. And so he got a loan from someone. He bought a concrete cutting machine and started his own business. And so in 1965, when he was like 25, let's say he was making like $30,000 a year, right? And his expenses, his cost for his lifestyle was like 10, right? So he bought a piece of property, a rental unit. It didn't make any money. In fact, the rent just covered the mortgage. But he just took some money that he didn't really need and he put it over here. And he said, yeah, it's going to cover the mortgage, right? It's going to bring down the cost of my mortgage. Every 5 years, I'll raise the rent. And the land will probably go up in value. He didn't even have a plan like in 20 years, 30 years. So you fast forward 5 years and he was making $50,000 a year. But he's only now spending about $12,000 instead of $10,000 for his lifestyle. So his lifestyle hasn't gone up exponentially, even though his money has. And so he had more money. It's like, yeah, I don't need it to affect my everyday life. I'm going to put it in this, or I'm put it in that. And these are not aggressive investments, right? Like he would buy I remember he bought a 56 Porsche because he said, they're not making any more of these, right? And just, had it in a garage, and then fast forward, he's making $70,000 a year, but his cost of living is only $15,000, right? And then he's making $200,000. It's only 30. Like the point is he didn't need this money, whether he was making the money in a market, whether he was making it with an engine, which was his business, his cost of living, what he needed to be happy and have a good life, didn't go up, and he had all this money. So he just kept putting it in places that weren't super aggressive, but places that just over time were assets that would grow and they would increase, right? So that's a hedging mechanism that you can do in the market, right? You can take money out, put it in other places. You can take money from a high risk investment. Like, let's say you made a ton of money in a biotech. Great. Take a good chunk of it, put it in an index fund. That's an asset. Yeah, it will go up and down a little bit, but over time, 10, 15, 20 years from now, it's going to be greater, right? So don't always think in binary terms. I've got to sell, or I've got to buy, or if I'm going to hedge something, I can only hedge it this way, or I've got to hedge all of it. In this case where the person's got the 2 or 3 stocks that have doubled, that would be a great scenario where you say, okay, I'm going to do the option play. I'm going to roll them into options. I'm going to keep my upside, but I'm going to protect my downside, right? Or I'm going to sell part of those stocks and buy some protected puts, right? Or I'm going to sell half of those stocks and take that money and put it in something else outside of the market that won't go up or down depending on what happens in the market. So uncorrelated assets. So, all right. I hope that helped. I hope it made sense. Again, if you have a question, you can just follow those parameters at the beginning, and maybe you'll see it in a future AMA. Talk to you next time.